If you're a property investor, you know the right tax strategies can make a huge difference to your bottom line. But with so much conflicting advice out there, it's tough to know what really works. That's where I come in, not just as a CPA, but also as a lending consultant, bringing you a well-rounded approach that covers both sides of the equation. Let's dive into my top tax tips to help you maximize your returns and avoid costly mistakes. First up, make sure you're claiming all eligible deductions. I'm talking about interest on investment loans, just the portion used to produce income plus borrowing costs like loan establishment fees and even lender's mortgage insurance. Don't forget immediate deductions like advertising, property management fees, council rates, water cleaning, gardening, pest control, and insurance. And for the big ticket items, think appliances or renovations get a professional depreciation schedule. That way you don't leave any money on the table. Next, know the difference between repairs and improvements. Repairs restore your property to its original condition and are immediately deductible. Improvements, like adding a new kitchen, need to be depreciated over time or added to your cost base. Mixing these up is a common mistake I see, and it can cost you at tax time. Record keeping. Yes, it's boring, but it's crucial. Keep every receipt, invoice, and statement for at least 5 years. If the ATO ever comes knocking, you'll be ready. When it comes to expenses, only claim deductions for periods when your property was genuinely available for rent. Apportion everything correctly. Don't get greedy. The ATO is watching, and compliance is key. Here's a pro tip. Consider prepaying up to 12 months of interest or insurance. This can bring forward deductions and give your cash flow a boost, especially if you know you'll have higher income this year. Capital gains. Tax is another area where planning pays off. Hold your property for more than 12 months, and you could benefit from a 50% CGT discount if you're an Australian resident. Offset any gains with available capital losses for extra savings. Don't overlook negative gearing. If your rental property runs at a loss, you may be able to offset that against your other income, reducing your total tax bill. But make sure it aligns with your broader investment strategy. Stay up to date on ATO focus areas. The rules change, and what was acceptable last year might raise a red flag today. Make sure your claims are accurate and well documented. And finally, structure your investments wisely. Consider asset protection, estate planning, and tax efficiency from day one. The right structure can make a world of difference as your portfolio grows. If all this sounds overwhelming, don't worry. Tax laws are complex and always evolving. That's why working with a qualified tax professional, someone who understands both tax and lending, can give you the clarity and confidence to make smarter decisions. Your financial journey deserves a holistic approach. If you want advice tailored to your unique goals, I'm here to help. Thanks for watching, and here's to maximizing your returns.